Revealed. Jeffrey Epstein's silver squeeze schema explained. In November 2025, the United States Department of Justice released 3.5 million pages of documents, files that were supposed to stay buried forever. Among them, an email dated May 27, 2011, sent to Jeffrey Epstein, subject line, Power of Attorney Silver Centrope. Attached to that email, a portfolio statement showing millions invested in silver mining companies, and a financial thesis, so precise, so calculated, that it predicted exactly what is happening to the silver market right now in 2026. This is not speculation. This is not theory. This is documented evidence of a scheme that connects Swiss private banks, offshore accounts, and a commodity squeeze playing out in real time. And the question nobody is asking is, who else knew? Welcome to Metal and Macro. If you followed markets long enough to remember when a handshake meant something, when due diligence wasn't just a checkbox, and when reading the fine print actually mattered, then you know this channel is built for your level of experience. We'd be honored if you'd subscribe. The way you might have once subscribed to the Financial Times or the Wall Street Journal, back when analysis still meant something. And please, take a moment to let us know in the comments where you're watching this from. Are you in New York, London, Singapore, somewhere the markets never sleep? We want to know who's paying attention, because what we're about to show you demands attention. In January 2026, researchers began the painstaking work of analyzing over 3.5 million pages of documents released by the United States Department of Justice. These were not ordinary files. They were the Epstein files, records that had been sealed, contested, and fought over in courtrooms for years. The Epstein Files Transparency Act, signed into law in November 2025, had finally forced their release. And the world watched as names emerged from the darkness. Presidents, princes, billionaires, tech moguls. The media focused on the celebrity connections, the flight logs, the photographs, the scandalous details that filled headlines and dominated cable news cycles. But a small group of financial analysts took a different approach. They ignored the famous names. They focused on the money. Bank statements, wire transfer records, portfolio summaries, offshore account structures, the financial architecture that made everything else possible. And buried deep within those millions of pages, on page 2417 of a document dump labeled Financial Correspondence 2010-2012, they found something extraordinary. An email, dated May 27, 2011, sent from a man named Bernard to an email address associated with Jeffrey Epstein. The subject line read, Power of Attorney Silver Centrope. At first glance, it appeared unremarkable. Just another piece of administrative correspondence between a wealth manager and his client. But the analysts recognized something immediately. The bank mentioned in the email, Artis, was not a typical financial institution. Artis was a Swiss private bank, the kind that required minimum account balances starting at $100 million. The kind that managed money for people whose wealth was measured in quantities that most human beings could not comprehend. Bernard was leaving his position at Artis, moving to another institution, and he needed Epstein to sign a power of attorney document before the end of the month. This would allow Bernard to continue managing what the email referred to as the financial trust. The language was clinical, professional, precise. But what caught the attention of the analysts was not the administrative request. It was the attachment, a portfolio statement. And next to that portfolio statement, another document, a detailed investment thesis focused on a single commodity, silver. The analysts began to read. The thesis was not written like typical investment research. It was structured like a strategic briefing, a military-style analysis of supply chains, market vulnerabilities, and leverage points. It identified specific weaknesses in the global silver market, outlined how industrial demand was increasing while mining production faced structural constraints, and explained how derivative markets created artificial price suppression that could not be sustained indefinitely. The document predicted a supply squeeze. Not someday, not eventually, but within a specific time frame based on measurable catalysts. The analysts cross-referenced the date, May 27, 2011. They pulled up historical silver price charts. In January 2011, silver had been trading around $28 per ounce. By April 2011, just weeks before this email was sent, silver had spiked to $48.70. Then the price had collapsed, violently, dropping more than 30% in days after the CME raised margin requirements 5 times in 8 days. The timing was remarkable. The email had been sent during the immediate aftermath of this price crash, when most investors were fleeing the silver market in panic. But the thesis attached to the email was not panicked. It was calm, analytical, and supremely confident. It treated the price crash not as a failure, but as an opportunity. The analyst then examined the second attachment more carefully. It was a JP Morgan portfolio statement, registered under the name Ghislaine Maxwell. The same Ghislaine Maxwell who is now sitting in a federal prison cell, convicted of sex trafficking, her name synonymous with one of the darkest criminal conspiracies in modern history. But in May 2011, her portfolio showed something else entirely. Millions of dollars invested in silver mining companies. Not physical silver, not futures contracts, but equity positions in the companies that extracted the metal from the ground. The analysts began to compile a list of the specific companies, the position sizes, the entry dates, and as they compared the investment thesis in the email against the actual portfolio execution, they realized something that made them stop. The strategy was not theoretical. It had been implemented precisely, systematically, with the kind of capital deployment that suggested institutional level coordination. This was not speculation. This was documented evidence of a calculated silver accumulation strategy, executed at the exact moment when the broader market was in retreat. And the thesis that justified this strategy, written in May 2011, described market conditions that were now, 15 years later, unfolding again in 2026, almost word for word. The analysts looked at each other. They understood what they were holding. This was not just a historical curiosity. This was a blueprint. The document was 17 pages long. It had no official letterhead, no corporate branding, no signatures beyond a digital timestamp. But the analysts who studied it recognized immediately that this was not amateur work. This was institutional-grade research, the kind of analysis that investment banks charged six-figure fees to produce, the kind of strategic intelligence that moved billions of dollars across global markets. Except this thesis had never been published. It had never appeared in a Morgan Stanley report, never been distributed to hedge fund clients, never been presented at an investor conference. It had been sent privately, to one man, in an encrypted email, and then buried in a vault of documents that were supposed to remain sealed forever. The analysts began their deconstruction on page 3. The thesis opened with a single premise that most market participants in 2011 would have dismissed as conspiracy theory. It stated that the silver market was structurally broken, that price discovery had been compromised by derivative leverage, and that physical supply was far tighter than official statistics suggested. But unlike typical conspiracy theorists, the author provided data, granular, specific, verifiable data. The document cited silver inventory levels at COMEX warehouses, tracked industrial consumption patterns across semiconductor manufacturing and solar panel production, analyzed mining depletion rates at major deposits in Mexico, Peru, and China. It referenced lease rates in the London bullion market, examined the short interest concentration among commercial banks, calculated the ratio between paper, silver contracts, and actual deliverable metal. And then it made a prediction that seemed absurd in May 2011. It predicted that within 10 to 15 years, the gap between industrial demand and mining supply would become mathematically unsustainable. It predicted that central bank monetary policy would eventually force institutional capital toward hard assets. It predicted that the derivative leverage suppressing silver prices would collapse under the weight of physical delivery demands. The analysts stopped reading and looked at the calendar. May 2011 plus 15 years. They returned to the document. The thesis identified 3 specific catalysts that would trigger what it called the physical reckoning. First, a sustained period of currency debasement that would destroy confidence in fiat money systems. The document specifically mentioned zero interest rate policies, quantitative easing programs, and government debt expansion as preconditions. In May 2011, these policies were just beginning. Emergency measures implemented after the 2008 financial crisis. By 2026, they had become permanent features of the global financial architecture. Second, a supply chain disruption event that would expose the fragility of just-in-time industrial logistics. The thesis suggested that any major geopolitical conflict, pandemic, or trade war would reveal how dependent modern technology manufacturing had become on uninterrupted silver supply. The analysts thought about the COVID-19 pandemic, the semiconductor shortages, the reshoring initiatives, the trade tensions between the United States and China. Every single element had materialized. Third, a loss of confidence in traditional financial intermediaries that would drive capital towards self-custody and physical assets. The document referenced historical banking crises, the collapse of MF Global, the rehypothecation scandals in London, the increasing awareness among sophisticated investors that paper claims were not the same as physical possession. By 2026, 3 regional banks had failed in the United States. Credit Suisse had been absorbed in an emergency merger, and the phrase, "not your keys, not your coins," had become conventional wisdom in investment circles. The thesis had not merely predicted the future. It had outlined the exact sequence of events, the specific psychological shifts, the precise market structure failures that would drive capital into silver. But the most disturbing section appeared on page 12. The document described a tactical approach for accumulating silver exposure before the broader market recognized the supply deficit. It recommended avoiding COMEX futures contracts, which the author described as vulnerable to rule changes and margin manipulation. It recommended avoiding physical silver bullion, which presented storage costs and liquidity constraints at institutional scale. Instead, it recommended equity positions in mid-tier silver mining companies, not the major producers like Pan American Silver or Cure Mining, whose stocks already reflected analyst coverage and institutional ownership, but secondary producers, companies with proven reserves, operational mines, and share prices that traded below net asset value because of temporary operational challenges or market pessimism. The thesis identified specific characteristics to screen for: companies with silver reserves in politically stable jurisdictions, operations with all-in sustaining costs below $20 per ounce, management teams with significant insider ownership, and enterprise values that implied silver prices below $15, despite spot prices trading above $25. The analysts pulled up the Maxwell portfolio statement again. Every single equity position matched these criteria exactly. She had purchased shares in First Majestic Silver, Endeavor Silver, Hecla Mining, Fortuna Silver, and 3 smaller companies that most retail investors had never heard of. The position sizes were not random. Each allocation represented approximately 3 to 5% of total portfolio value, a professional risk management approach that suggested institutional discipline rather than speculative gambling. The entry dates clustered around late April and early May 2011, immediately after the silver price crash, when fear was highest and valuations were most compressed. This was not luck. This was execution of a predetermined strategy, implemented with precision timing, backed by analysis that had somehow predicted market conditions 15 years in advance. The analysts sat in silence. They understood what they were looking at. This was not investment research. This was intelligence, the kind of intelligence that required access to information flows that ordinary market participants never see, the kind of strategic positioning that suggested coordination at levels far beyond individual wealth management. And the question that nobody wanted to ask out loud was becoming impossible to ignore. If this thesis was written in 2011, and it predicted 2026 with this level of accuracy, who else received it? The JP Morgan account statement was dated June 15, 2011, 19 days after the Bernard email. The analysts noticed this timing immediately because in the world of institutional money management, 19 days represented something significant. It was the standard settlement window for transferring power of attorney, executing new account agreements, and implementing revised investment strategies after a wealth manager changed firms, which meant the portfolio they were examining was not a historical snapshot. It was the result of deliberate action, taken in direct response to the thesis outlined in Bernard's email. The statement showed total account value of $47 million. Not billions, not the kind of capital that moves markets through sheer size, but $47 million deployed with surgical precision could achieve something far more valuable than market impact. It could achieve information advantage. The analysts began tracking each position individually. First, Majestic Silver, 180,000 shares purchased at an average price of $11.23 per share. Total position value, approximately $2 million. The analysts pulled up historical price charts. On June 15, 2011, First Majestic was trading near its lowest point of the year, down nearly 60% from its April peak of $24.87. The broader market had concluded that the silver rally was over, that the CME margin increases had successfully crushed speculative excess, that prices would continue declining. But the Maxwell portfolio showed accumulation, not liquidation. Endeavor Silver, 220,000 shares at $7.89 per share. Another $1.7 million deployed. Hecla Mining, 425,000 shares at $6.14 per share. $2.6 million. Fortuna Silver, 310,000 shares at $5.37 per share. $1.6 million. The pattern was unmistakable. Every position had been initiated during the exact window of maximum market pessimism, when technical analysts were calling for further declines, when momentum traders were shorting mining stocks, when retail investors were capitulating in panic. But there was something else the analysts noticed. The position sizing was not equal. Each allocation varied between 3.4% and 5.8% of total portfolio value, suggesting a weighted approach based on company-specific factors. They cross-referenced each company against the screening criteria outlined in the thesis. First Majestic, primary silver producer, mines in Mexico, all in sustaining costs of $10.80 per ounce. Management owned 23% of shares. Match. Endeavor Silver Chospa, pure silver play. Operations in Mexico and Chile, costs of $12.40 per ounce. Insider ownership at 18%. Match. Hecla Mining, oldest precious metals company in North America. Silver reserves in Idaho and Alaska. Cost of $11 or $90 per ounce. Family controlled with 31% insider ownership. Match. Every single position aligned perfectly with the thesis parameters. This was not portfolio construction by a retail investor reading newsletter recommendations. This was institutional-grade execution, implemented by someone with access to fundamental research that the broader market had not yet absorbed. The analysts then did something that made their discovery even more disturbing. They calculated what those positions would have been worth 5 years later. In June 2016, First Majestic Silver, purchased at $11.23, had reached $9.87 by June 2016, a loss of 12%. Endeavor Silver, purchased at $7.89, had fallen to $3.21, a loss of 59%. Hecla Mining, purchased at $6.14, was trading at $3.89, a loss of 37%. On the surface, the strategy appeared to have failed catastrophically. Any normal investor who bought silver mining stocks in June 2011 and held them through 2016 would have experienced severe losses, would have questioned their thesis, would have concluded they had been wrong. But the analysts understood something that most people missed. They extended the timeline. By December 2020, after 9 years, First Majestic Silver had reached $14.96. Endeavor Silver had climbed to $5.47. Hecla Mining had recovered to $6.73. The positions were approaching break-even, but still nothing spectacular. Then they looked at 2024. First Majestic Silver, $8.23, still underwater. But then something changed in late 2024 and early 2025. The analysts pulled up current prices as of February 2026. First Majestic Silver, $18.47, a 64% gain from the original entry price. Endeavor Silver, $6.89, still down 13%, but recovering. Hecla Mining, $9.34, a 52% gain. And the smaller positions, the companies that retail investors had never heard of, one had increased by 340%, another by 287%. A third had been acquired at a premium valuation, delivering a 156% return to shareholders. The analysts calculated the blended portfolio return, approximately 94% gain over 14 years and 8 months. Not spectacular by venture capital standards, but extraordinary by one specific measure. They compared this return against the S&P 500 over the same period. The S&P 500 had returned 223%, more than double the mining portfolio performance, which meant any rational investor who had simply bought an index fund would have done far better. But the analysts understood why this comparison was irrelevant. They examined the correlation between the mining portfolio and the S&P 500. During market crashes in 2015, 2018, and in 2020, when the S&P 500 dropped by double digits, the silver mining positions had behaved differently. Sometimes they fell harder, but sometimes they rose. The correlation was inconsistent, unpredictable, which meant the portfolio was not designed to maximize returns. It was designed as insurance, a hedge against a specific scenario, the scenario outlined in the thesis. And that scenario was not measured in 5-year returns or 10-year performance. It was measured by what happened when the financial system experienced stress. The analysts pulled up price movements from March 2020, when COVID-19 lockdowns triggered global panic. First Majestic Silver, up 47% in 6 months while the S&P 500 was still recovering losses. Hecla Mining, up 89% in the same period. Then they examined late 2024, when regional bank failures had triggered concerns about financial stability. First Majestic Silver, up 34% in 4 months. Hecla Mining, up 41%. The pattern was clear. This portfolio was not designed to outperform during normal conditions. It was designed to explode during the exact conditions that the thesis had predicted would eventually arrive. And those conditions, after 15 years, were finally materializing. The analysts looked at each other across the conference table. They had just documented something that should not exist, evidence of a financial strategy, implemented in 2011, that was specifically designed to profit from market conditions in 2026, conditions that had been predicted with precision in a document that was never supposed to see daylight. The question was no longer whether the thesis was accurate. The question was, how many other people received this analysis? The analysts created a spreadsheet. On the left side, they listed every prediction made in the May 2011 thesis. On the right side, they documented current market conditions as of February 2026. What they discovered was not coincidence. It was a blueprint being executed in real time. The thesis had predicted that global silver inventories would decline as industrial demand outpaced mining production. In May 2011, COMEX registered silver inventories stood at approximately 103 million ounces. By February 2026, those inventories had fallen to 41 million ounces, a 60% decline over 15 years. But the decline was not linear. The real collapse had occurred in the past 18 months, from September 2024 to February 2026, when inventories had dropped from 87 million ounces to 41 million ounces, a loss of 46 million ounces in less than 2 years. The thesis had predicted this acceleration. It had stated that inventory drawdowns would remain gradual during periods of economic stability, but would intensify rapidly once institutional capital recognized the supply deficit. The analysts examined industrial demand data. In 2011, global silver demand for solar panels was approximately 23 million ounces annually. By 2026, that number had reached 161 million ounces, a sevenfold increase. The thesis had specifically identified solar energy expansion as a primary demand driver, at a time when most investors viewed solar as a niche technology with uncertain commercial viability. But solar was only one component. Electronics manufacturing, automotive applications, 5G infrastructure, defense systems. Every category of industrial demand had increased beyond what mainstream analysts in 2011 had considered possible. Total industrial demand in 2011, approximately 487 million ounces. Total industrial demand in 2026, approximately 712 million ounces. Meanwhile, global mining production had barely changed. In 2011, annual silver production was approximately 735 million ounces. In 2026, production had reached 822 million ounces, an increase of only 87 million ounces over 15 years, less than 12% growth. The thesis had predicted this production stagnation. It had explained that major silver deposits required 7 to 12 years to move from discovery to production, that environmental permitting had become increasingly difficult, that ore grades were declining at existing mines, and that most silver was produced as a byproduct of copper, lead, and zinc mining, making it unresponsive to price signals. Every single element had materialized exactly as described. But the most disturbing validation appeared in the derivatives market. The thesis had warned that paper silver contracts on COMEX represented leverage ratios that could not be sustained if physical delivery demands increased. In May 2011, the ratio of paper contracts to registered physical inventory was approximately 47 to 1, meaning for every ounce of deliverable silver in COMEX vaults, there were 47 ounces worth of futures contracts claiming ownership. By February 2026, that ratio had exploded to 124 to 1. The leverage had nearly tripled, and unlike 2011, when most contracts were held by speculators who had no intention of taking delivery, the analysts discovered something that made their blood run cold. Delivery notices on COMEX silver contracts had increased by 340% in the past 6 months. Institutional buyers were demanding physical metal, not cash settlement, not rollover contracts, actual silver. The exchanges were experiencing what the thesis had called the physical reckoning. The analysts cross-referenced this against statements from central banks and sovereign wealth funds. In January 2026, the People's Bank of China had announced a strategic metals reserve expansion, including silver. In December 2025, the Russian central bank had added silver to its official reserve classifications. In November 2025, 3 European pension funds had publicly disclosed positions in physical precious metals, citing monetary system uncertainty. This was not retail investor fear. This was institutional capital repositioning for a scenario that the 2011 thesis had described as inevitable. The analysts then examined current silver mining equity valuations. First Majestic Silver, trading at $18.47, represented an enterprise value that implied a long-term silver price of $19.20 per ounce. But spot silver in February 2026 was trading at $32.40 per ounce. The disconnect was enormous. Endeavor Silver, Hecla Mining, Fortuna Silver. Every company in the original Maxwell portfolio was trading at valuations that assumed silver prices would collapse back to 2015 levels, despite physical inventories at 15-year lows, despite industrial demand at all-time highs, despite delivery pressures on futures exchanges reaching critical levels. The market was pricing these stocks as if nothing had changed, but the thesis had predicted this too. It had explained that equity markets would be the last to recognize the supply deficit, that institutional analysts would continue using outdated models, that price discovery would remain suppressed until a forcing event created undeniable physical shortages. The analysts identified what that forcing event might be. In February 2026, 3 major solar panel manufacturers had reported production delays due to silver procurement challenges. In January 2026, A defense contractor had filed a regulatory notice disclosing that weapon system production was constrained by materials availability. In December 2025, an automotive electronics supplier had warned that EV component manufacturing faced silver supply risks. These were not speculative concerns. These were Fortune 500 companies, publicly traded entities with legal disclosure obligations, reporting that they could not obtain sufficient silver to maintain production schedules. The thesis had described this exact sequence. It had stated that industrial users would be the first to experience physical shortages, that their public disclosures would force financial markets to reprice silver assets, and that the repricing would be violent and sudden because institutional capital had ignored the fundamentals for too long. The analysts looked at the calendar. 15 years had passed since the Bernard email, 15 years since Ghislaine Maxwell's portfolio had been positioned according to a thesis that seemed absurd at the time. And now, in February 2026, every prediction was manifesting. The inventory drawdowns, the industrial demand surge, the production stagnation, the derivative leverage crisis, the institutional repositioning, the equity valuation disconnects, all of it, precisely as described. The analysts understood what this meant. Someone in May 2011 had possessed information that allowed them to see 15 years into the future, not through speculation, not through luck, but through access to data flows and strategic intelligence that ordinary market participants never see, and that someone had shared this analysis with Jeffrey Epstein, a man whose entire operation was built on information asymmetry, on knowing what others did not know, on positioning capital based on intelligence that was not available to the public. The analysts closed their laptops. They had documented the evidence, they had verified the predictions, they had confirmed the timeline, but they could not answer the question that mattered most. If this thesis was accurate enough to predict market conditions 15 years in advance, and if it was distributed to select individuals in May 2011, how many fortunes have already been built on this information? How many institutions positioned themselves while the rest of the world remained ignorant? And most importantly, what else did they know? The silver market in February 2026 was not experiencing a random supply shortage. It was experiencing the final stage of a plan that had been set in motion 15 years earlier. A plan that was now, finally, reaching its conclusion.